Imagine you send a large transfer to a new account and your bank stops it. You call expecting a normal fraud check, but behind the scenes, your bank may also be allowed to ask another financial institution whether the same name, phone number, device, IP address, or payment pattern has shown up somewhere else. That is the practical money question in this video. Your bank may not just monitor your own account anymore. Under updated guidance from FinCEN on June 12, 2026, financial institutions have clearer permission to share suspected fraud information with each other under a rule called Section 314B. This does not mean your bank can casually publish your private information. It does not mean every unusual transfer makes you a criminal. And it does not mean a suspicious activity report gets passed around from bank to bank. But it does mean the banking system is moving further toward real-time fraud detection. Banks are being encouraged to connect the dots across institutions, not just inside one institution. That can protect people from scams. It can also mean more legitimate customers run into extra questions, delayed transfers, account reviews, documentation requests, or false alarms. So let's make this plain. Think of bank fraud like a person running through a building with many separate rooms. Each room has a security guard, but the guards do not always talk to each other quickly. A scammer can try one room, leave, walk into another room, use a slightly different name or account, and keep going. Section 314B is one of the legal tools that lets financial institutions talk to each other when they suspect certain financial crime activity. It has existed for years. The June 12th update matters because FinCEN clarified that suspected fraud can fit within this sharing framework, and that sharing can happen in real time. In plain English, FinCEN is saying, if a participating financial institution sees something that looks like fraud connected to money laundering or other covered criminal activity, it may share related information with another eligible participating institution, as long as the program rules are followed. The phrase that matters is safe harbor. A safe harbor is a legal protection. It means that if a financial institution follows the rule, registers properly, verifies that the other institution is also a participant, protects the information, and uses it for the permitted purposes, the institution gets protection from certain liability for sharing that information. This is important because banks normally treat customer information as sensitive. If a bank is worried that sharing too much could create legal risk, it may hesitate. FinCEN's update reduces some of that hesitation when the issue is suspected fraud. Now let's separate three ideas that often get mixed together. First, there is normal fraud monitoring. This is when your bank watches your transactions for unusual activity, a new device, a large transfer, a login from a faraway location, or a sudden payment to a new recipient might trigger an alert. Second, there is Section 314B sharing. This is when eligible financial institutions voluntarily share information with each other to identify and, where appropriate, report activity that may involve money laundering, terrorist financing, fraud, or other covered unlawful activity. Third, there are suspicious activity reports, usually called SARs. A SAR is a confidential report that a financial institution may file with FinCEN when it detects activity that meets suspicious activity reporting rules. Section 314B can help banks gather information that may lead to a better SAR, but the SAR itself is still highly confidential. The basic point for consumers is simple. Banks may share the underlying suspicious indicators under the rule, but they generally cannot just share the SAR or reveal that a SAR exists. That distinction matters because the headline version of this story can sound like banks are handing each other secret government files. That is not the core mechanism. The mechanism is more like institutions comparing fraud signals so they can decide whether a payment, account, or customer relationship needs more review. What changed on June 12th? The rule did not appear out of nowhere. Section 314B comes from the USA PATRIOT Act. The banking system has used it for information sharing around money laundering and terrorist financing for a long time. The June update clarified several practical points. FinCEN said the program can cover information related to suspected fraud because many fraud offenses can be connected to the legal category of specified unlawful activity. That is a technical phrase, but the plain version is that fraud can be one of the crimes that sits behind money laundering concerns. FinCEN also made clear that a bank does not need to have already identified the exact proceeds of a fraud before information sharing can be protected. Suspicion can be enough if the other requirements are met. FinCEN also clarified that information sharing can happen in real time. That matters because fraud does not wait for a monthly compliance meeting. A scam payment can move quickly. A stolen identity can be used at multiple institutions in a short period. A money mule account can receive funds and move them out before anyone finishes a slow investigation. So the update makes banks more like connected fraud sentinels. One bank might see the start of the pattern. Another bank might see the destination account. A payment app or money services business might see the transfer behavior. A brokerage or finance company might see a duplicate identity. The point is not that every institution sees everything. The point is that the legal path for sharing certain suspected fraud information is clearer. If you find explanations like this useful, this is a good time to subscribe. We focus on the money systems that affect ordinary people, not just investing headlines, so you can understand what is happening when banks, regulators, debt, taxes, fees, and risk show up in real life. Now let's talk about what kind of information can be shared. FinCEN's fact sheet gives examples that are more concrete than many people expected. A financial institution might share transaction information. That could mean the timing, amount, destination, or pattern of payments. It might share video surveillance footage. Imagine someone withdrawing money at a branch or ATM after an account takeover. If the same person appears at another institution, that could matter. It might share cyber-related data, such as IP addresses, geolocation information, or device identification numbers. These details can help detect when many accounts are being accessed from the same suspicious device or location. It might share decisions related to account creation, account maintenance, account closure, or services. That means the fact that one institution rejected an account opening or closed an account after suspicious activity could become relevant to another institution's review. It might share transaction monitoring alerts or indicators that activity may be suspicious. For example, a newly added payee followed by a large transfer. Multiple accounts opened with the same or similar name, address, phone number, email, or other identifying details. Logins from places geographically distant from the customer's normal location. A cluster of accounts receiving funds and quickly sending them onward. Notice what all of these examples have in common. They are not just opinions, they are signals. A single signal may mean nothing. People travel, people buy expensive things, people open new accounts, families share addresses. Remote workers use virtual private networks. A person might send a large transfer for a home purchase, a car, tuition, a business invoice, or a family emergency. But fraud systems do not usually look at one thing in isolation. They look for patterns. That is the trade-off. The more aggressively banks connect fraud signals, the better they may become at stopping fast-moving scams. But the same system can also catch legitimate activity that happens to look unusual. Here is a simple example. Suppose you normally keep a checking account for payroll and bills. Then one week, you log in while traveling, add a new payee, and wire a large amount to a title company for a home closing. From your point of view, this is normal. You are buying a home. From the bank's point of view, several risk signals just appeared together. New location, new payee, large transfer, high-pressure deadline, possibly a wire, which can be hard to reverse. If another institution has recently seen scams involving a similar destination, device, email address, phone number, or payment pattern, your bank may ask more questions before sending the money. That delay may be annoying. In some cases, it may protect you from wiring your down payment to a criminal. In other cases, it may just slow down a legitimate transaction. Now imagine another example. Someone steals personal information and tries to open accounts at 3 banks. The first bank sees the application and notices that the device has been connected to suspicious account openings. The second bank sees the same phone number paired with a different name. The third bank sees a new account immediately receiving transfers from scam victims. If each bank only sees its own room, the pattern is harder to spot. If they can share relevant indicators under Section 314B, the pattern becomes clearer. That is the argument for the guidance. Fraud often moves across institutions. A scammer may use one bank to receive funds, another payment platform to move them, a crypto exchange or money service to convert them, and another account to withdraw them. If each institution sees only one slice, no one sees the whole trail in time. The consumer concern is also real. A system designed to detect patterns can make mistakes. It can confuse unusual but lawful behavior with risky behavior. It can place extra burdens on people whose financial lives do not fit neat categories. For example, a person who works irregular jobs may receive payments from many sources. A small business owner may move money between accounts often. A person supporting family overseas may make recurring international transfers. A student or new immigrant may have thinner records. A caregiver may help manage someone else's bills. A person without traditional documentation may already face more friction opening and maintaining accounts. The June 12 FinCEN update arrived in a broader policy conversation about customer screening and suspicious activity reporting. Associated Press coverage connected Treasury's actions that day to a wider push involving bank data sharing, customer risk review, and suspicious activity reporting. Some of that conversation has also raised concerns around immigration-related screening. The important thing is to separate what the FinCEN 314B guidance says from what people fear could happen next. What is known is that FinCEN clarified fraud-related information sharing under Section 314B, including real-time sharing and examples of shareable indicators. What is also known is that banks already have obligations to know their customers, monitor transactions, and report such suspicious activity. What is not proven from the guidance alone is that every ordinary customer will face new checks, or that banks will suddenly share all customer data all the time. A good way to understand this is to think about airport security. Most travelers are not suspected criminals, but everyone moves through a system designed to detect risk. If your bag has something unusual, you may be pulled aside. Sometimes the system catches a real threat. Sometimes it wastes your time because the scanner could not tell the difference between a harmless object and a risky one. Bank monitoring works in a similar way. It is not personal in the emotional sense. It is pattern-based, but it still affects real people personally when money is delayed, frozen, or questioned. So how could this show up in everyday life? You might get more verification messages when making unusual transfers. You might be asked why you are sending money to a new recipient. You might be asked for an invoice, contract, closing statement, proof of sale, lease agreement, or other documentation for a large transfer. A bank may delay a wire or ACH transfer while it reviews the activity. An account opening could take longer if your identifying information resembles information connected to suspicious activity elsewhere. A bank could restrict an account while reviewing whether activity is fraud-related. You may also see more friction when the transaction is high risk in a practical sense. Wires, instant payments, new payees, international transfers, large cash movements, and sudden changes in account behavior tend to attract more scrutiny. None of this means you did something wrong. It means banks are increasingly judged not only by whether they process money, but by whether they catch suspicious money movement before losses spread. There is a quiet change happening in what people expect banks to be. For a long time, many people thought of a bank as a vault. You deposit money, the bank keeps records. You withdraw money, the bank follows instructions. The modern bank is also a filter. It filters for fraud. It filters for sanctions risk. It filters for money laundering risk. It filters for identity theft. It filters for suspicious patterns that regulators expect it to notice. The June guidance strengthens that filter by encouraging banks to share more of the signals that help them identify fraud across institutional boundaries. Now, this raises a fair question. If banks can share more fraud data about you, what can you do as a normal customer to reduce false alarms? You cannot control every algorithm, but you can reduce avoidable confusion. First, keep your contact information current. If your bank sends a fraud alert to an old phone number or email address, a simple verification can turn into a bigger problem. Update your mobile number, email, mailing address, and security settings before you need them. Second, prepare documentation for large or unusual transfers. If you are moving money for a home closing, vehicle purchase, tuition payment, business invoice, family support, investment account transfer, or estate matter, keep the paperwork easy to access. A bank employee may not need the whole story, but they may need enough evidence to understand the purpose of the transaction. Third, tell your bank before unusual activity when it makes sense. If you are traveling, making a major wire, or expecting a large incoming payment from a new source, a short call or secure message may help. It will not guarantee that nothing gets flagged, but it can create context. Fourth, respond quickly to legitimate bank alerts. Fraud teams often work on short timelines because criminals move money quickly. If you ignore a real alert, the bank may treat the silence as another risk signal. Fifth, use secure channels. If you receive a text, email, or call claiming to be from your bank, do not click random links or give out codes to someone who contacted you unexpectedly. Go through the bank's official app, website, card number, or branch. A fraud prevention system is only useful if you do not hand the keys to an imposter. Sixth, know the escalation path before a crisis. If a transfer is delayed or an account is restricted, ask the bank what department is reviewing it, what documents are needed, whether there is a case number, and when you should expect an update. If the issue is urgent, ask whether there is a fraud department, wire department, branch manager, executive office, or formal complaint process. Seventh, keep records of conversations. Write down dates, times, names, reference numbers, and what documents you submitted. This is not about being combative. It is about making the review easier to follow if the case gets passed from one team to another. The main mistake to avoid is assuming every bank question is an accusation. Sometimes it is just a control point. Banks ask because fraud losses are real, because regulators expect monitoring, and because once money leaves an account, recovery can be difficult. The other mistake is assuming every bank question is harmless. If your account is frozen, if your money is delayed, or if a bank repeatedly cannot explain what it needs from you, that can create serious practical stress. You may need to escalate, document, and use the bank's complaint process. In some cases, people also look to consumer regulators or legal help, depending on the situation. A balanced view is better than panic. The new guidance is not a magic fraud shield. Scammers will still adapt, false positives will still happen, banks will still make judgment calls, and consumers will still need to be careful with their own information. But the guidance does clarify a major shift in the plumbing of finance. Fraud prevention is becoming more networked. The bank that holds your checking account may care about information seen by another bank, a money services business, a brokerage, a credit card system, or another eligible financial institution. Your transaction is no longer judged only by what it looks like inside one account. It may be judged against wider patterns. That is why this matters now. If your money life is simple and predictable, you may notice nothing. If you make large transfers, run a small business, travel often, support family across borders, use multiple institutions, or change accounts frequently, you may run into more verification. The goal is to stop fraud before it spreads. The risk is that legitimate customers can get caught in the filter. The practical response is not fear, it is preparation. Keep your information current. Keep documents for major transfers. Use official bank channels. Respond quickly to alerts. Ask for clear escalation steps. And remember that a delay is not the same as a verdict. The simple takeaway is this. Your bank is becoming less like a silent vault and more like a node in a fraud detection network. That network can protect your money, but it can also create friction when your real life looks unusual to a risk system. If you have questions about how this works, or if you want a future explainer on SARs, frozen accounts, bank privacy rules, or what to do when a transfer gets flagged, leave a comment with the topic you want covered next.